Open. Blackstone and Google just announced a partnership to build a TPU-based cloud platform sitting on Blackstone's physical data center infrastructure. The headlines are calling it a cloud story, an AI story, a compute story. That framing is going to cause real capital allocation errors. Here's what I'm actually reading. Blackstone does not structure a partnership at this scale and this visibility unless the physical infrastructure is already in hand or under controlled acquisition. You do not go to market with Google's name attached and then go find the land, the substation agreements, and the fiber routes. That sequencing doesn't work. What this announcement confirms is that Blackstone has already solved the two hardest problems in data center development right now: guaranteed power delivery and hyperscaler-grade offtake commitment, before a single press release dropped. That's the model. And it's the model that is going to make roughly half of the speculative data center pipeline being marketed today functionally unfundable, because those deals are being underwritten against a demand curve that is no longer available to operators who haven't pre-solved power. What this tells me as an allocator is specific. The next data center deals that actually close at defensible basis are going to be won by operators who can hand a hyperscaler or a colocation anchor a term sheet that includes guaranteed megawatts and lit fiber density before the tenant signs an LOI. This Blackstone Google structure is the institutional proof of concept for that thesis. So let's go deep on what the data actually says, why the mechanism is moving now, and where there's still a real entry point for capital operating below the mega fund threshold. The data layer. Start with the supply-demand dislocation, because the numbers are stark. According to CBRE's 2024 Global Data Center Trends Report, North American data center vacancy in primary markets, Northern Virginia, Dallas, Chicago, Phoenix, Silicon Valley, dropped to approximately 3% by mid-2024. That is not a typo. 3%. For context, Class A industrial in the tightest Sunbelt markets is running 4 to 5%. Data center vacancy in Tier 1 markets is tighter than best-in-class logistics. JLL's data center outlook for H2 2024 put total U.S. absorption at over 5 gigawatts of new leasing activity for the year, against a construction pipeline that is physically constrained, not by capital availability, but by power. Their research identified 8.1 gigawatts of projects currently in the pipeline that are either delayed or stalled specifically due to utility interconnection timelines. The queue for new grid interconnection in PJM, which serves the Northern Virginia corridor, has exploded to over 2,700 projects representing more than 800 gigawatts of requested capacity. Average interconnection wait time in that queue is now running between 4 and 7 years depending on project size and location. On the transaction side, Real Capital Analytics and Green Street have both tracked a meaningful repricing in powered shell and build-to-suit data center assets. Green Street's net lease and industrial desk put stabilized cap rates for hyperscaler leased data centers in the 4.5 to 5.5% range for long-duration paper, 10-plus-year triple-net structures with investment-grade counterparties. Blackstone's own QT's platform, which they took private in 2021 for $10 billion, at that point the largest data center acquisition on record, has since been marked up materially and is the direct infrastructure vehicle through which this Google partnership is being executed. QT's was underwritten at roughly $678 per square foot at acquisition. Comparable powered shell trades in primary markets are now being quoted in the $900 to $1,200 per square foot range, depending on power density and fiber access. The Blackstone Google deal also has to be read alongside Microsoft's $500 million campus commitment to Stargate, Amazon's $150 billion infrastructure spend announcement, and Meta's 2 gigawatt data center campus in Louisiana. The hyperscalers are not buying spot capacity. They are locking up infrastructure relationships for the next decade. The mechanism. Why is this vertical integration happening now? Specifically, 3 converging pressures. First, the GPU depreciation cycle. H100 and H200 clusters are depreciating on an 18 to 36-month effective useful life for cutting-edge inference workloads. That's not GOP depreciation, that's competitive obsolescence. When your compute hardware turns over that fast, your biggest operating leverage point is no longer the chip cost, it's whether the facility powering that chip can scale power density fast enough to absorb the next hardware generation. Modern AI training clusters are pushing 50 to 100 kilowatts per rack. Legacy data centers were designed for 5 to 10. That physical density gap cannot be retrofitted cheaply, so hyperscalers are going directly to infrastructure partners who can build to spec from ground up. and they want those partners locked in contractually before ground breaks because the alternative is a 24-month construction cycle with no offtake certainty. Second, utility grid reality. The U.S. electrical grid is simply not capable of meeting near-term data center load growth through normal interconnection channels on the timelines hyperscalers need. This is not a political statement, it's an engineering and regulatory constraint. New 138 kV or 345 kV substation interconnections require NER-compliance studies, utility cost allocation negotiations, and in many jurisdictions, state PUC approval processes that run 3 to 5 years. The operators who have already navigated that process, who hold existing substation rights, who have executed power purchase agreements, who are sitting on land with live utility interconnection, those operators have a structural moat that is not reproducible on a 12-month development timeline regardless of equity check size. Third, the debt market is bifurcating this cleanly. Construction financing for speculative data center development, no anchor tenant, no power commitment secured, is pricing at SOFR plus 350 to 450 basis points from regional lenders, with tighter LTV constraints and significant interest reserves. Deals with a hyperscaler offtake in hand, even an LOI, even a letter of intent with conditions, are financing 50 to 100 basis points tighter and attracting more capital from insurance company balance sheets and infrastructure debt funds. The market is already pricing the power certainty premium into the debt stack. The equity implication is obvious. Basis protection is coming from the pre-committed offtake, not from buying cheap land, where mid-market capital fits. Here is where I want to be precise, because the Blackstone Google deal is $10 billion plus of infrastructure and most people watching this are not deploying at that scale. The opportunity for capital operating in the $20 to $100 million equity check range is not to compete with QTs or Equinix on hyperscaler campuses. That ship has sailed. The opportunity is in the 1 and 2 megawatt edge deployment segment, and in the powered shale acquisition play in secondary and tertiary markets, where the anchor tenant is not Google, but is a regional cloud service provider, a federal agency, or a managed service provider that needs proximity and latency characteristics that Northern Virginia can't provide economically. Specifically, I'm looking at markets like Hillsboro, Oregon, where power is cheap and Google and Intel already have infrastructure pull-through effects on the grid, Columbus, Ohio, a Tier 2 market where AEP Ohio has been aggressive on new interconnection and where land basis is still sub $200,000 per acre in accessible corridors, and San Antonio, where CPS Energy has actively courted data center load as an economic development strategy and where the utility relationship can be navigated in 18 to 24 months rather than 5 to 7 years. The deal structure I'm underwriting in these contexts is a development to core play. Acquire or control land with existing utility proximity, execute the interconnection agreement, pre-lease a minimum of 60 to 70% of capacity to a credit-worthy anchor, regional carrier, federal contractor, multi-tenant co-location operator, and bring in construction financing against that committed offtake. Target unlevered yield on cost in the 8 to 10% range, with exit cap rate assumptions of 5.5 to 6.5% to core plus buyer or REIT. Generating a levered IRR in the mid-teens on a 4 to 6 year hold. That spread between yield on cost and exit cap is where the value creation lies, and it is only achievable if you are buying power, not just buying land. Counter positions and risks. Let me be honest about what can break this. The primary risk is utility timeline slippage. Even with an interconnection agreement in hand, utilities have discretion on construction phasing and can reprioritize load additions based on grid stability requirements. I've seen 18-month timelines stretch to 36 months without triggering formal breach, which creates carrying cost exposure that can erode a 200 basis point spread quickly. The second risk is tenant concentration. A 2-megawatt facility with one anchor tenant at 70% occupancy is not a diversified asset. If that tenant downsizes their footprint at lease renewal, which is a real pattern as hardware efficiency improves and workloads consolidate, you are releasing into a market that may have added supply in the interim. Underwriting to vacancy scenario matters. Third, the hyperscaler co-investment thesis I'm articulating here is not a guarantee. The Blackstone Google announcement is a leading indicator, not a template that every operator can access. You cannot cold call Google's real estate team and replicate this relationship. What you can do is be positioned in markets and with infrastructure characteristics, power, fiber, cooling redundancy, that make you a viable acquisition or JV target for operators who do have those relationships. Positioning matters even if you're not at the table. And finally, power cost inflation is a real variable. Commercial electricity rates have increased 15 to 20% in several primary data center markets over the past 2 years. PPA structures can hedge this, but they require scale and creditworthiness that not every operator can execute. If you're underwriting a fixed-cost power structure and rates continue moving, your operating margin compresses and your exit multiple gets questioned. The position I'm taking here is what I'm actually doing right now. I'm actively underwriting a powered shell conversion opportunity in a secondary Midwest market, existing industrial basis, 69 kilovolts transmission access within a half-mile, current zoning that supports the use by right. The sponsor has a soft LOI from a managed service provider anchor that would take 1.2 megawatts of the 2 megawatt build out. My underwrite is testing basis sensitivity against a utility interconnection timeline of 20 to 28 months, and I'm stress testing exit at a 6.75% cap, which is conservative relative to where comparable assets have traded but reflects genuine uncertainty about secondary market liquidity. In a rising rate environment, I'm also looking at a GP stake opportunity with a regional data center operator who has 3 campuses in active operation and 2 sites in pre-development, all in markets where they have existing utility relationships. The thesis there is not one deal, it's access to a pipeline of deals where the power problem is already solved and the question is capital to execute. That's a different risk profile than a one-off development. What I'm not doing is writing equity checks on merchant data center development where the power solution is described as in process and the tenant profile is broad market demand. That's the 2021 underwriting standard being applied to 2025 constraint environment. The Blackstone Google announcement should make it very clear, the deals that close are the ones where power is already solved and offtake is already committed. Close. The Blackstone Google TPU partnership is not a cloud story. It's a physical infrastructure story about who already holds the megawatts, the fiber, and the contractual relationships that make hyperscaler deployment possible at speed. The implication for mid-market capital is precise. The basis advantage in data center real estate is no longer land cost, it's power certainty and pre-committed offtake. Half the pipeline currently being marketed doesn't meet the threshold. The deals that do are either getting done quietly or are in secondary markets where a disciplined operator has already navigated the utility relationship. That's where I'm spending my time. If you are a principal, a sponsor, or a broker with a deal where the power story is real and the offtake structure is at least partially committed, reach out, DM me at @DeBrody Official. I'll look at everything that comes through there personally.